Are we asking too much to expect gold's price to respond dramatically to inflation like pretty much everything else in our economy has?
Just look at the 1929 market crash, which led to the Great Depression. We will mirror the collapse, but only briefly. And you can look at 2008, it happened again. It's positive for us in the longer run, but scary as hell when it initially turns.
The worst day on Wall Street since the crash of 1987.
We're now down 43%.
This could be the most serious recession in decades.
Protect your retirement with a gold and silver IRA. Learn more at sdbullion.com/IRA. Hey everyone, thanks for watching Yankee Stacking. Did you know that gold briefly surpassed $2,500 an ounce last Friday? That probably seems like an eternity ago, but it was the first time in history that happened. In early trading, the spot price hit $2,522.50 before shedding its gains to trade at $2,475.90. And that is, of course, before suffering collateral damage on Monday when the stock market got whacked. Silver got shredded on Monday as well as recession fears throttled up. But what about that brief all-time record high of $2,500 an ounce for gold? Big deal. Gold's inflation-adjusted all-time record high is actually over $3,200 an ounce. And on a side note, silver's inflation-adjusted all-time record high is over $140 an ounce. So even with this recent precious metals speed bump, gold's got a long way to go before it's made up that gap between its nominal price and the price inflation we see everywhere in our economy. And I won't even go into the fact that I'm basing this off of bogus government CPI figures. The nominal price of gold should probably be twice that when adjusted for real inflation. So I'm going to talk about this more with my guest today, Luke Norman, the chairman of U.S. Gold Corp. But this won't be a softball interview. Okay, I'm going to ask Luke some rather tough questions, including some viewer-submitted questions as well. So hit that like button, sit back, and enjoy the interview. Welcome, Luke. Thanks for joining Yankee Stacking and also for sponsoring this interview. Appreciate it.
Absolute pleasure to be here. Thanks, Yankee.
All right, so I got to ask you a question right off the bat. Are you a gold and silver stacker?
Come on.
Are you?
I've got my pocket change here in front of you, but I love the stuff. You can't own enough.
Wow. What? No, I want to see that again. What was that? That was gold?
We got 3 ounces of gold there and a couple of ounces of silver from a couple of old companies I was involved with.
Excellent.
But, this is the pocket change.
That's awesome. No, you got to have the physical, right? Definitely need that. That's
Absolutely.
Insurance. So, Luke, are we asking too much to expect gold's price to respond dramatically to inflation like pretty much everything else in our economy has?
Asking too much? No, it just seems to be a delayed effect. These fiat currencies are just playing havoc with real life and people's real lives and right down to the confidence of the consumer. So, no, I think we're going to well beat where we were in 1980.
I asked my local coin shop dealer, Tim, to guess where gold would be by the end of the year. His guess was $2,500 an ounce. It was just a guess. What's your guess, Luke?
Look, I do believe higher than that, probably $2,800.
Wow.
But I always feel that if we get close to that $2,800 mark, we're just going to push through 3,000. So, but I really think that we're just dealing with a reality in the fiat currency debacle that we've lived under for the last 50 years is starting to become unhinged. And that's what you're seeing. That's what we're witnessing. I think if you get a change of government, I think that's going to have a huge effect. But we're seeing that polarity happening across all spheres, Australia, New Zealand onwards. So hopefully in Canada too soon.
So earlier in July, last month, before gold made its run up to nominal highs, the GDX and the GDXJ reached 52-week highs before the spot price of gold hit its highs. And to me, that's very interesting because for a long time, the gold stocks have been lagging the metals. And that was the first time in years that the gold stocks led gold futures. In a true bull market, mining stocks usually lead metals, but it's been the other way around. Investors seem really hesitant, Luke. They seem nervous about buying gold stocks. But now I'm beginning to sense that that's changing, that there may be anticipating a breakout. Do you agree with this analysis at all, Luke?
Absolutely. I've been calling it an inelastic distribution between the moving price of gold and the lack of investment into the sector. And to your first point, I think that initial blip was the more sophisticated investors in the space realizing they're grossly underweight, dove in, filled their coffers, and now we're waiting for the market to wake up.
All right, some viewer questions.
Okay, all right, I'm ready.
So Antonios from Greece asks, when the Fed pivots and the dollar crashes, what will happen to my mining stocks?
No, next question. Just joking. Thank you. There's an active example you can refer to, Antonios. Just look at the 1929 market crash, which led to the Great Depression. Gold stocks followed the Dow down 90+% before becoming 600% on the positive side through 32, I believe, and continued on. Why? Because you couldn't even own physical gold at that period during the Great Crash. So we will mirror the collapse, but only briefly. And you can look at 2008, it happened again. So it's positive for us in the longer run, but scary as hell when it initially turns.
Wow. Right. So
it's not easy to ride a bull. Ask any cowboy.
Good analogy. He also asked this: are we going to see an ETF, likely BlackRock owned, consisting of all mining stocks?
Well, I think that's just going to be a natural progression when capital inflows come back into the sector, which they will. We talked about that inelasticity. When the capital flows come in and there's a business model for them to pursue, of course they will do it.
That's from Antonios. He says from bankrupt Greece.
Well, I think all countries are, Antonios, so you're not alone.
Another viewer asks, what would a recession mean to a junior mining company's operational costs?
Okay, so, I mean, the recession on operating costs, I mean, recessions can also be somewhat deflationary. So operating costs, it wouldn't have a huge effect on. Maybe it would create better, fuel, energy prices, etc. So it'd be a positive. But again, refer back to Antonios's first question that on the equity side, it would have a huge increase after the initial drop. And so that's going to cause less equity dilution for capital raises needed for maybe upgrading production or different things. So overall, it would still end up being positive.
All right, here's another question. What does it cost you to mine an ounce of gold out of the ground?
For us over at US Gold Corp, we're advancing this copper gold porphyry sitting just outside of Cheyenne, Wyoming. Location is important. That's why I brought it up. Our ASIC, or all-in sustaining cost, at that project is forecast to be $800 an ounce using the benchmarks of $1,625 gold and $3.25 copper. So, well in that 50% margin. Now, the majors in the same sort of reporting area, $1,200, $1,300, $1,400 an ounce ASICs when gold was at $1,600 an ounce. So you can see a massive difference in margin there.
That's a big difference. Yeah.
Yes.
All right. The same viewer also asked, do you lease or own your mining equipment?
Well, so we're not mining yet, of course. So we're at feasibility. We're doing all the optimization, fun stuff that, engineers do, and I don't. We are under our feasibility study right now. We used leased equipment. We actually use contract miners. So it's their equipment, not ours. We just pay them by the ton. If something breaks, they fix it.
Okay, last question from our viewers. Why would I gamble on a junior mining company, Yankee?
Okay, so just as important as it is to have this, absolutely agree, you need to own physical. But how do you get the best leverage out of that? The best leverage into gold
Mm-hmm.
is owning the explorers, because when they make a discovery, you get this massive return. Then it goes into mid-tier and then obviously producers. But the largest amount of leverage in a gold bull cycle is exploration discovery. But that's by far the highest risk. That's why the highest return.
High risk,
I
high
think
return.
owning producers will give you the best return and more leverage than you get just from your physical, but you need both.
Excellent. Yeah, I would also add that there is, I think, a big difference between gambling, speculating, investing, saving, and insuring. I don't gamble. I do speculate a little bit in the junior mining sector because I do think the upside potential is so huge. But I don't own any shares in U.S. Gold Corp. Luke, not yet. The ticker symbol's right there, USAU, and it's on the NASDAQ. You know, I am evaluating your company against what I call the Yankee quadrant. These are 4 factors that help me decide whether or not I should invest in a mining company: management, projects, ownership, and the 4th is financials. Why don't you briefly touch on all 4 for us?
Management. I brought in the guy who built the biggest gold mines on the planet for Barrick Gold Corp. So a guy that can build these extraordinarily big mining operations in South America can certainly dig a hole in Cheyenne, Wyoming at a fraction of the size.
Wow.
What was the next one? Sorry, Yankee.
Projects. Tell me about
Projects.
just your flagship project.
Flagship CK, which stands for Copper King. Don't let that scare you. It's 70% gold, 30% copper on state ground in the state of Wyoming. No federal nexus, just a community that wants the business, wants the revenue, and wants us to go ahead. Not to mention, Yankee, we're one of probably only 5 permitted, bucket-ready to go gold mines in North America, and that includes Canada.
Just one of 5.
Yeah, as an unmined, like permitted, ready to go. There's mines in production, of course.
Yep. That's awesome. It's hard to get permits now, isn't it?
It's impossible on federal ground because they're afraid of their own shadows. So they're all dealing with federal bureaucracies. But for us to get permits I've got a silver company as well called Silver One. For us to get permits to drill down in Arizona, 3 years, just to drill, not to mine it.
Wow. Ownership, insider ownership. Really, when I say that, I want to see, skin in the game.
Easy answer. Take a look at our capital structure. Look at our shares outstanding. 10.7 million shares. Find a peer group comparative that has anything close to as few shares. We're very protectionist about our share issuances. Why? Because we own the company. I have a massive amount of my personal capital invested in this. It needs to be a success for everyone. The only way it is if it's a success for me as an investor. We spent $30 million on project advancements and permitting and all the different things, big milestones when we were the highest risk. Now we've just expunged those risk factors. So, we have around $4 million, $4.5 million in cash, but again, very tight share structure, a lot of interest in wanting to invest into our capital, into our company. The one thing that's scaring people a little bit right now, they're like, but you need to raise $250 million to develop this. It's not going to be through equity, okay? Again, I'm a shareholder of the company. We've got a myriad of different ways to get this up and producing. And that's a very low-cost operation relative to it.
Excellent rundown. Well, let me just tell you 2 things that I really love too. One is that you're in a friendly U.S. jurisdiction.
Yes.
Location, right? I also love that you're on the NASDAQ. It's a lot easier to invest when you have a good ticker symbol like that. All right, guys, time to chime in. Down in the comments below, what do you think of Luke's earlier answers on gold and his value prop with U.S. Gold Corp? Maybe put in some questions I didn't ask him that you wish I did. Speaking of which, Luke, if people have more questions, how can they reach you?
Well, firstly, I have a question for me that you didn't ask. And what is that value proposition?
Good. You ask and answer your own question, Luke.
Yeah, we have about a $60 million market cap right now. In a normalized market with our current NPV 5, we'd be trading, it's a $325 million NPV 5. We would be trading around 0.8 of that, given that we're a permitted reserve quality asset. That's just where we sit right now. where we would be relative to a normalized market. So yeah, I would ask about those valuation metrics. And feel free to reach out to us. You know, we have a website, obviously. There's contact information there. I love answering questions. There's no stupid question, especially from an investor. So have at her.
Great. I'll put all that information in the description of the video below, so check it out. And thanks so much, Luke, for joining me. I really appreciate it.
Thank you, Yankee, and keep up the great work.